Gold was given a decent lift to the upside yesterday in the wake of the US inflation numbers. There was a major spike in volatility, but ultimately when things settled down, in the wake of the US inflation numbers, we saw a dip in US government bond yields and in turn a dip in the US dollar. And there's often a strong inverse relationship between the US dollar and gold. So the weakness in the dollar pushed gold on higher. Now, what sparked all this? The inflation numbers yesterday from the US showed us that the CPI reading moved from 4.2% to 5%, topping the 4.7% expectation. This is what sparked the major volatility, and even though inflation is clearly running high in the US, as we've heard from the Federal Reserve in recent weeks and months, they believe that the increase in inflation is only going to be transitory. So overall, we actually saw weakness in the dollar, which actually pushed gold to the upside. As you can see, the broader upward trend for gold is to the upside. While the metal holds above these simple moving averages, it's likely the wider upward trend is going to continue. A move higher from here could see a target 1903, and a break above that could see a target 1909. Now, if we do see gold turn over on itself, we could look to find support at the recent low at 1869, and if we do have a sizable break below that, we could see a retest 1855. Now, why is inflation important? Well, the Federal Reserve have their meeting next week on Wednesday, and even though they are expected to keep rates on hold, traders are going to be very keen to find out what does the Fed think of the fact that inflation in the US is now running at 5%. If the Federal Reserve reiterates the old view that inflation pressures are going to be transitory, it's likely we could see continued weakness in the US dollar, and therefore that probably see a continuation in the upward trend in gold. Conversely, if the Federal Reserve alter the language and they seem a bit concerned about CPI being at 5%, that could push up the US dollar, and in turn we could see weakness in gold. Also next week we have US retail sales to be posted, so that will give us a good indication of demand in the US, because as you've seen in recent months, more and more Americans are going back to work, but ultimately, are they going out and spending money? Because it's going out and spending money is what's helped the economy move on to the next stage. Also this week, what has been in play, the British pound continues to be fairly strong. Andy Haldane, the chief economist for the Bank of England, gave a very bullish update on the UK economy. He talked about how the strong vaccination rollout has helped the UK outstrip other countries, be it big G7 countries or Eurozone countries, in terms of the kind of reopening performance. But he also cautioned about higher inflation. And on next week from the UK, we have CPI numbers and we also have retail sales numbers. Both of these reports will give us a good indication of demand in the UK. As I mentioned with the US, it's all about, are we seeing consumers, individuals going out and spending money, because that's effectively going to get us out of this rut that was caused by the lockdowns as a response to the COVID-19 pandemic. Taking a look at the price action in the British pound, the longer trend has been to the upside. We reached a multi-year high not that long ago, but since then, since that high was achieved, it's largely been range bound. We're currently around the top end of the range, and while we hold comfortably below the lower end of the range, it's likely the broader upward trend is going to continue. So if we move on higher from here, we could look to retest 1.4201, and a break above that could see us retest the recent multi-year high in a 1.4248. Should we drift lower on the British pound, we could look to head back down towards 1.4072, the recent lower, the lower end of the range. And if you do have a break below that, that'll be quite significant, because that could suggest the range has been broken to the downside, so it could be the beginning of a deeper correction. And if you do have a move below 1.4072, it could take us back down toward this area here, just north of 1.4005.